Yeah. Okay. Perfect. Thanks.
Start looking over my shoulder, wondering if somebody's spying on us. First, markets and lending. Again, investment property purchases are up 77% since the start of the pandemic. So there's a lot of investors out there looking to scoop up these properties. And I'm sure that has to go in conjunction with the pricing and the rates for investment properties are up as well. And a couple interesting things from the economic point. In September of 2021, there were some constraints on lender investment properties lifted. I don't know if anybody was really paying attention or aware that last year, Freddie and Fannie, a lot with some political inspiration, they changed. So all lenders, when they were supplying the paper, secondary market paper, we originate the loans, whether it's whichever bank, all the big banks, the brokers, everybody, were sending paper to Freddie and Fannie, but they limited each investor, each institution to only 7% of their paper could be investment paper. So you see that large increase in investment property purchases. There was a large demand of loans coming through, but Freddie and Fannie changed that and said, hey, only 7% can be that paper. So what's the easiest way to shift that? You raise the prices. So every lender was pushing up the prices significantly last year, specifically on investment properties, all sorts of COVID adders or whatever you want to call them. They did that. There was a lot of pushback in DC and it went through the housing administration and they pulled those constraints back. So they lifted that back off. I don't know if anybody ran into that or was aware of it, but there were a lot of lenders that just would not do investment properties or even second homes for a period. And that was the primary reason why they did that. Rolling forward, we came through just in February of this year, they've shifted adjusters for second homes. So the pricing on second homes right now is identical to that of investment properties. It used to be you could get the same rates for a second home or a vacation home that you could with buying your own property for yourself, your family at the coast or up in the mountains, and it wasn't a bad deal. They've adjusted those now. So effectively, they're almost identical, which made a lot of things easier for us in terms of a lot of investors wanted not a pure investment property or rental, but more a VRBO or a B&B, Airbnb. And it became kind of a problem on, well, you can't use the income if you're calling it a second home and vice versa. Well, that did simplify it for me because now it's essentially all investment property. The only difference between the two, and we'll see that down in a couple of slides, is the amount of down payment that's required is significantly less if you're calling it a true second home or a vacation home. But the pricing is going to be essentially identical. And let's see. So here's some of the general market trends that we're seeing with low inventory driving the competitive market. Home buyers are experiencing increasing challenges. Well, there's a shocker to everybody, right? Okay, so that part is, no surprise, but that is a trend. And based off what we're seeing right now, it's still continuing in this area. The demand is still exceedingly high, and it is driving prices. Not necessarily the increase that we saw last year, but they are, there's still some upward pressure on there, and we are still seeing a lot of bidding on properties. As far as the rates are projected to continue to increase through 2022. We were talking a little bit about this before we officially got started. I personally think the rates are just going to keep on a steady tick up through, and forecasting wise, I'd think they're probably, for a regular home purchase for an owner occupied, you're probably looking at 4.5% by the time you get to the fall. But again, who knows? All the professional forecasters had said that, oh, we might get close to 4% by the end of 2022. Well, we already exceeded that a couple of weeks ago, which dropped back down a little bit. Again, world markets, volatility, all these things are really keeping the mix up, and there's no trend or pattern right now. Home prices are expected to stay strong with a few dips in values. The last one I saw nationally, they're forecasting a 5% increase again this year, which there's a lot of folks out there that are hoping that they're going to drop back. But again, you've probably got more realtors that research this more than I do. I just kind of ask around and I read some reports out there, but that's kind of what I was running into, is thinking, okay, it's going to be modest, but still equity increases this year, even with those massive 16, 17% gains nationally last year. The flip side, I guess, is the rents are up 11 or 12% over the past 12 months. And a concern that I've run into with a lot of investors that I talk to is that they're saying, well, yeah, but that's the prices are outpacing the rents that we're getting. I think there's a lot of new regulatory stuff. And obviously with the COVID, hey, you don't have to pay. You've got all these things going on. I think there's been a lot of pressure to keep the rents down from following suit with the pricing, but it's still tracking with it. And I'm not sure, again, in Oregon, Washington, there's slightly different rules. I think, what did they say? I don't know what the percent is increase that they're allowed to do from a rental standpoint this year, but 9% or so. I think it's 9. Yeah. So, it is capping, and say, well, if the prices go up 15%, I can only push up my rents 9. It's, obviously a net loss. So, play the long game on that one and see if you're still getting your ROIs and it pencils out. So we go in and just kind of define, again, we're talking about this from a residential lending standpoint. Commercial lending, different ballgame. There are a whole bunch of different programs, institutions. I know Umpqua Bank, we've got some specialty things that we can do, hybrid properties and all this sort of stuff with investors, half rental, half occupant kind of thing. But every institution is going to have their own version of their commercial lending that would apply, which you can certainly do with residential properties. You can roll them into commercial financing, but the rates and terms tend to be a little bit more favorable if you can keep it in the bucket and call it a residential investment property. So single family, duplex, and 3 or 4 unit properties are in the conforming bucket, or that's what home lending is going to look at in terms of being eligible types of properties. They can be stick built or modular, but you cannot have man homes and bare land in terms of investment financing. Bare land, those lot loans, they are coming back now for construction purposes, but those are really primary and secondary homes. And there's a lot of parameters tied to that. But man homes, as far as straight investment properties, you're going to have to pay cash for those things if you want them. And then there's some unique properties, log cabins, A-frames, some kind of funky rural properties. And again, those are going to be essentially, are they common enough for the area to get comps? That's what underwriters always come back to, is, are there comparables? And how does this look in terms of what's common for the area? And are they going to be able to pull enough data to give a solid report? We run into that all the time. People call and ask frequently, hey, do you guys do these kinds of properties? And the answer is always the same from underwriting, is going to be, can an appraiser find comps? And what are we looking at? Then we get into hybrid properties, which can be kind of complicated, multi-use. So you've got, hey, there's this property, they've got, there's a single family residence on there that rents out, but currently there's a 12,000 square foot shop in the back that is being rented out to a self-employed mechanic that has something. Those can get kind of complicated, especially if there's leases involved, or a rural property where maybe it's 20 acres, you want to rent the house, but there's a lease with a farmer. So that one can stem into a whole bunch of questions going down. But if there's any recorded leases on a property, it's going to be very difficult to get through underwriting. If it's a handshake type of thing, great, no problem. It doesn't exist on paper. There's nothing that's going to show up on a title report as far as existing leases or anything, then hey, great, you should be okay on that. But ADUs, those are becoming more and more popular and allowed in a lot more communities than used to be. Again, because of the housing shortage, they're being pressured to kind of lighten up on that. And then there's multiple structure types. This is where people find one where, hey, there's a stiff built home, but there's a man home out there. It might be a good cash flowing scenario for you, but that's going to cause problems in any underwriting scenario because, again, we're down to a man home on an investment property and it's going to get excluded. So it gets a little bizarre case by case, but that's a good thing. If you have a good lender that you're working with and you need financing for it, know as much as you can about the property and get that pre-vetted so you can kind of go through and look at that and see what you're going to be facing. And then we run into ones where it's multiple tax lot scenarios. Say, for example, you're buying a home, it's on a 2-acre parcel, but there's another 15-acre one and they're selling it all together. You could do that, but again, this is where they go back to the appraiser, right? Highest and best use. Is it for a residential property? Is it a buildable lot next door? Then it becomes more difficult to do. Sometimes you still can, but it becomes a math problem. What's the land worth relative to the loan amounts and things like that. So hate to be ambiguous, but it's when properties get in these mixed kind of hybrid scenarios, it can become a little challenging. But as we're seeing out there, the plain cookie cutter vanilla house on a city tax lot is not as easy to find, and you start to have some of these more interesting looking properties out in the weeds. So
hey, Brent, real quick,
yeah.
If you go back, so are you saying that on the unique properties, the hybrid properties and multiple tax lot scenarios, those generally wouldn't fit into conforming loans, and you guys need to hold the paper, or are you going to get into that in a minute? I'm sorry.
Yeah, I'll get into it a little bit, but as a general rule, most of the held loans from an institution or portfolio loans, the majority of those places, whether it be, and they're typically going to be the larger banks that have money, your Wells, your Chase, your B of A, Umpqua does them. We've got our portfolio loans. There's a few nuances where we can sometimes squeeze in properties that wouldn't fit inside the Freddie and Fannie box, but most of the lenders are going to adhere to Freddie and Fannie as a baseline and then typically have their overlays on top of that. So I would say most of the time it's going to be difficult, but every property is a little bit different. And that's where you can get as much information on the property and then talk to your lender, give them or her all of the specifics that you can on the property and have them try to vet out and say, hey, go to your underwriters, see is this going to be something that's live? Do we have a portfolio product that we may be able to fit that in? It's not necessarily out of the game. But in terms of how to buy those, sometimes you got to go cash. And that's where we'll get into a little bit, showing some examples of this down the road in this presentation on how you can maybe leverage cash out of other properties to pay cash for something that may not qualify for a residential loan, just to kind of leverage yourself. That's where the fun in this game comes in. It's hard being a math geek and looking at stuff all day long. People look at you funny, but it's kind of fun when you got to play the game a little bit. So as far as the products themselves, and this is where you might see a few things that you weren't aware of, that you have your regular non-owner occupied investment property. That's your standard plain vanilla. Hey, I'm going to buy this as an investment property, conventional 1 to 4 units. I put 15 to 25% down required. You're going to get butchered if you don't put 25% down. You can do them technically on paper, but the adjusters are pretty significant if you put any less than 25% down. And the portfolio loans that we have 30% down for the same 1 to 4 unit parameters. So that's your standard non-owner occupied investment property. The interesting ones come in when it's multi-unit owner occupied. So you buy a duplex, you live in half of it, but you want to make some money off the other side of it. You can go with conventional on a 2 unit, 15% down, 3 or 4 unit, 25% down, very similar to just the plain investment. But you can actually do, the big ones are like FHA. You can do a 2 to 4 unit with 3.5% down. And most people don't know that. I had one client bought a 4 unit property, put 3.5% down, rented out the other 3, and they actually lived in 1 unit for free and were making money off of the other ones with very minimal investment relative to what you would think you'd have to have in the market. VA does have some similar programs like that, but they're pretty rare, and that's a very stars have to line up kind of scenario for that. And then we have some portfolio stuff that we do also 2 to 4 unit with as little as 5% down. So it can be done in a multi-unit scenario. And this is a way a lot of investors start out, where they buy a multi-unit property and live in one of them for a period of time, get enough cash flow up, and then just have it be a straight rental down the road. But it's a nice way to get into something with a minimal down if you needed to cash flow something. And maybe you don't have that much for income, but you can subsidize it with these rentals from the other units and actually find a pretty cheap place to live if you play the game. And especially that FHA one freaks people out. You'd be surprised. But something to think about. I know this one came up in the last conference call that we had, or the last Zoom meeting, and Ryan mentioned this one, how title and ownership can be held. And it must be held because a loan is done on the residential side to an individual or a person or persons. So everybody on it, individuals, married couples, or even partners, what have you, can do that. Some trusts, you can buy it into trust if the folks on the trust are the same people on the loan. You can't have some on and some off and vice versa. But again, a married couple, for example, they have a trust and everything they have is in a trust, they can buy it with the trust and title will be held in the trust. And that's kind of a unique one. We run into that every now and then. Typically some older couples that are wanting to buy some things. The big one is no LLCs. And that one, a lot of attorneys, for a very good reason, advise people put it in an LLC. It protects you, and that's great. The loans cannot be done in an LLC, nor can they be put into an LLC after you get them. That used to be the old trick back in the day was, hey, just get it in your own name and then roll it into an LLC afterwards and just go down and record it that way, do a quick claim and get that thing in the LLC. The lender actually isn't going to know until they renew the insurance, and then they'll call you out. They can call the note on that. Usually what you do is you just get a hate mail letter from them that says, hey, put this back in individual names or we're going to call the note. But that LLC is kind of a stiff one to use on people that were traditionally thinking, oh yeah, you put it in there, that makes a lot of sense. The way around that, I've personally found, is you go to your insurance folks and you get an umbrella policy over the top as kind of a cushion. That kind of helps alleviate a little bit that pressure, and they're pretty cheap. And that's, at least for me personally, that's the best line of defense that I've found to protect yourself from anything that may happen with the property. And I believe there's individual policies you could probably get for properties. I haven't really investigated it a whole lot, but that is a big one when people want to get into the investment game, is they want to put everything in LLC. Once you own it free and clear and you don't have a loan on it, not a problem. If you're getting a commercial loan on it, then it's a property, you can do that. The main reason is because, again, they do loans to individuals, not companies, and an LLC is a company. So there's no one personally to hold liable for the repayment of that loan. And then it's just kind of the last tier on there. There are financing property limits. So if you want to get a conventional loans and you want to have a big portfolio and you're building these things up, you're allowed to have up to 10 financed properties and still be eligible for Fannie Mae. A trick around that I have some folks that have 15, 18 properties is if you have a partner, your spouse, for example, you go in and say, hey, they buy 10 in their name, you buy 10 in your name. And you can keep financing all the way up to that limit. You do have to plan out a little bit ahead of time, a few years ahead, to kind of line that stuff up. But it is a way to leverage and still be able to utilize conventional loans and go over that 10 property limit. And then when you get into institutions, portfolios, you can go over that 10 limit. Each institution will have their own exposure limits, but they don't really care about how many properties you have. They typically care about the total dollar amount of exposure that they have lending out to you. So I'm sure guys have specific questions on that, but we could hit that as needed. Just a quick reminder, most people again know this, the conforming limits on loans, for the most part, Oregon. There's some high cost areas that bump these up. Obviously, you get down into California and whatnot, there's a lot of them, but for the most part up here, these are your conforming loan limits. What gets in people's heads is sometimes like, oh, well, there's a 2-unit property and they think the conforming loan limit, they revert back that 647. It actually jumps up pretty good. So you could still get a conforming loan on a 4-unit property for over 1.2 million. And again, that's just kind of like, oh, okay, I don't think about that a whole lot. Again, you can go into the portfolio range if you get above that conforming limit, which quite honestly, the rates are better on that anyway, right now for some of that stuff. So kind of an interesting thing, but I like just bringing that up just to show folks as a reminder that has gone up significantly in the last few years. One thing I like to hit on these things is the property condition. So a lot of times you're buying something that's, the proverbial fixer-upper or, needs some love, and you get into the very complex deal on, well, there's repairs that need to be done. The seller can't get them done. They don't have the money. I don't want to put money into it till I own the thing. And you're kind of stuck in this vortex. And when you're buying an owner occupied property, it's fairly common to do holdbacks. Hey, it needs a new roof on it. Seller doesn't have it. I'm not putting one on till I own it. Great. We can pull money off in the process and have it done after the fact. But they're extremely difficult to get approved for investment property scenarios. Just the risk factors are high, and they tend not to do that unless it's something very specific. And we can show that, hey, we need a new roof. The weather's horrible. They need a break in the weather. Might be able to go through, but that's a case-by-case basis, underwriter by underwriter. And they will typically be able to do something simple, provided it gets done quickly. And the big one is like, hey, can we get a property inspection waiver? In other words, an appraisal waiver. This we'll get into here, but it's pretty difficult. Just consider yourself going to have to get an appraisal on the property if you want to use the rental income to help qualify. If you don't need it, that's an exception that can occur. If you're putting 40% down, or say, for example, on a property, it's a fixer-upper, the value's there on paper in the system, they'll say, yeah, you don't need an appraisal. Great, that's good, provided you don't need the rental income to offset it. If you've got enough income in your regular qualifying on your application, you can wash that through, and sometimes you can get it, which is great. If you can go in there and buy something cheap, put a large amount down, go in and do the repairs yourself after the fact, you get a loan on it, no big deal. But the repair issue has become, because obviously there's a lot of properties out there now that they become available. They might be a good deal, but they're going to need $40,000 or $50,000 put into them first, and nobody's going to do it until they own it. So that can be kind of a struggle. But again, we get creative with the lending on how we can get through it or get those things done. And if you're lucky, great, you can get that exception to get that not needing the rental income to qualify, and then it can go through. So just a little side note. When it comes to the rental income, lenders are allowed to add in the rental income to offset the mortgage payment. Most people need this, especially the first or second one that they're getting. There's a few conditions that apply. So if there is a current lease agreement in place, in other words, if they've got renters in there right now, the lenders are going to require to get a copy of that lease agreement. We're going to see, hey, they're paying $1,200 a month for it. I don't know. Can anybody get rent for $1,200 a month anywhere? I don't know, but maybe some small stuff, but there's a lease agreement. So we want to get that. The lenders are always going to want that. So when you're doing a transaction, if you're a realtor, you get those things ahead of time, know what your tenants are paying. And then regardless of what the lease agreement is, part of the appraisal, you're going to get a rent comp survey. So part of the appraisal is going to have an analysis done saying, hey, what would this property rent for? And the lenders are going to use, it's kind of in small writing there, but the lenders will use the lower of the two figures as far as what we can use. Once we get that figure, then we're going to go, you see on the far right there, when calculating the rental income, the lenders are going to use a 75% figure for that. That will basically is their mathematical version of compensating for repairs that might need to be done, occupancy, vacancies, rebuilding things, whatever it might be. So that's kind of the raw formula. So if we'll look at the crayon math here, an example, you would have 75% to offset the payment. So if you have an $1,800 lease agreement, $1,350. So then $1,350 can then be applied back towards the mortgage payment. And I've noticed usually with most like single family residences, especially if you're putting 25% down, once you figure out this, the math tends to come out where you're cash flowing net, usually about $200-300 a month after your mortgage payment's covered. So hopefully that figure that we use can be applied towards it. And the reason that's important is because if your debt to income ratios, when you buy rental properties, hopefully they kind of pay for themselves on paper. And if you do it right, your debt to income ratios will actually go down every time you purchase a property. And so it sounds kind of counterintuitive, but people with 4 or 5 investment properties tend to have lower and lower debt ratios, and it gets easier and easier to purchase things because of that. So here's a kind of a more complex version of the same thing. So let's just say you're getting a 2-unit duplex, $450,000. Borrower's putting 25% down. You have a 337 loan amount. Let's just use 4.25 for an interest rate on that. See what your principal and interest, your taxes, your insurance. So your total mortgage payment, around that $2,100 mark. The seller currently has 2 tenants running $1,200 for each side. So you've got $2,400 a month in rental income. And then as part of the process, you had to get a rent comp schedule on your appraisal, and it came out at $2,600. Okay, that's great. They're going to go with the lesser of, right? So you've got the $2,400 that they're going to use, multiply it by 0.75, and you've got $1,800 a month to offset that $2,100 mortgage payment. So you can see the down payment, the closing costs, and then when you're getting investment properties, reserves are a big thing that a lot of people don't take into consideration. That's a Freddie Fannie thing, and they're going to typically require 6 months of reserves for each investment property that you have. So having a good pile of cash behind the scenes after it's all said and done is something that doesn't come up a lot. People say, hey, I got enough for the down, I got the closing costs, I'm ready to go. And then this one comes in the 11th hour and they're like, oh, shoot, I don't have enough. And it can be a significant number if you've got 5 or 6 rental properties. You may have to have $50,000 or $60,000 in reserves. That does not have to necessarily be liquid cash sitting in the bank somewhere. It can be investment funds. It can be, anything that you may have out there, annuities or something. But something that, in the unlikely event of a water landing, you could access that cash and make those payments. And this last year is a perfect.
And IRAs and retirement funds applied, right? Okay.
Yeah, anything that you could liquidate if you had to, even if you had to take a penalty on it, they could figure that out. And this last year is a good example of why, when they had that rent freeze on everybody, they didn't. Hey, you still got to make your mortgage payments as an investor. You can't go to the bank and say, well, my tenants aren't paying. The government told them they don't have to. They don't care. You're still on the hook for that because, as an investor, you're classified as a rich person and therefore you can afford it. So you're going to have reserves to be able to make those payments before maybe you don't even get compensated for them. I don't know. It could be pretty brutal this last year. But that's the reason for it, requiring that to make sure that you're still going to be solvent and you're still going to be okay. You're not depending on those payments every single month just to keep from defaulting on your loan. And I put in just at the bottom, if you have a 1031 account to apply, the funds can be used for the down payment and some of the closing costs. The 1031 company you may or may not work with can usually give you details on that. But the timelines for the processing, the funds have to be used, identify the property within, whatever it is, 90 days or 120 days and closing within X, Y, and Z. Those can be a little bit tenuous to kind of work through, but anybody that's done a few of those, kind of knows how it worked. But if you're on kind of the first round of that one, get a hold of that 1031 company, find out, what their timeframes are going to be, how quickly they can do that, and then verify that you can use that 1031 money for some of the closing costs. That can help a lot in terms of, you don't just need extra cash. You're going to probably need some, but not a whole lot if you really apply it correctly. So this is kind of a little matrix as far as, you know, the asset and funds needed for closing. So the down payment, pretty self-explanatory, depending on the program. Again, with an investment property, you're typically 25% is your optimal. You can use the 1031s. You cannot use gift funds. And this is a big one that a lot of people, well, my dad's going to help me out and give me an extra 20,000 so I can get to that 25% and do this. Unless dad's on the loan, it's not going to work. It's got to be from the borrower's own funds, whatever source that may be. And then I'll get into something here in a minute, and this is where it gets in the creative component, is secured funds are allowed. So you can borrow from other properties, and that's okay. So a lot of people get HELOCs or do a cash out refinance on one of their other properties, be it a primary or an investment property, another one, and pull the cash out. And those are all totally fair game funds to use for down payment, closing costs, and that sort of thing. And I'll show an example of that coming up here. But and then I just mentioned the closing costs. When people talk a lot, there's a lot of confusion sometimes. Closing costs versus closing costs and prepaids for taxes and insurance. Make sure you're getting a clear picture from your lender on, you know, what's the true bottom line net number that you're going to need to come in with, especially if you're playing with 1031 money or whatnot, because obviously 25% down and some other funds, those dollar amounts can add up pretty quick. And then you're shaking the couch cushions trying to make something fit. So do the math ahead of time and then be in position. And then again, I hit that reserve component. Depending on the program, it's usually 6 months PITI for each investment property. So just do the rough math on that, so you know what you're walking into. Sometimes the lenders don't bring that up until you're kind of halfway through the process, and it can kind of deflate your balloon pretty quick. So I did put this matrix up here, not that anybody probably wants to fixate on it a whole lot, but Fannie Mae, Freddie Mac, and FHA. Your down payment. Again, that FHA on the far right, 3.5%, regardless of how many units it is. If you're going to live in it, that's pretty good. Most people are looking at the single 1 unit investment purchase line item, and pretty close. You've got, 85%, so 15% down minimum required, technically. But again, 25%, you see those pricing adjusters for that extra 10%, it's going to be pretty hideous. And that's across the board. And then, of course, you can see refinancing in multi-units. So just like to throw that in there, just so you can kind of see, roughly what we're looking at for some of those investment down payment minimums. So here's an example of, when we're trying to leverage funds and kind of get into that. So buyer has an existing home. They're going to pull money out of their primary residence. It's valued at $600,000. They owe $300,000. They can go down to whatever bank or credit union they're at, pull out, go up to 80%. So in this case, you can get a new loan, or you can have your combination of your first and your second go up to 480. So you essentially have access to about 180,000 on a HELOC. Those are pretty easy to get. They're cheap to get. Depending, there's some promotions going out now, some pretty cheap money on some 1 and 2 year money out there on HELOCs right now. They are typically variable rate, but it's good Band-Aid money to use if you really got a good deal that you're, think you can get, but you really need a chunk of money to get in the game. So in this case, hey, you find an investment property for 400,000, 25% down, you want to go in, great, use 100,000 of it. You've got an extra 80 to work with off that HELOC, all your closing costs, prepaids, and your reserves. And then you're in the game. So you don't necessarily have to have a pile of cash itself sitting on the side. You can leverage something. Your existing primary residence will be the cheapest money for sure. But that's the way most people go at it when they're really needing a big chunk, because properties are costing so much now. But so that was kind of the nuts and bolts of it. These are just some of the questions that people have come up with, over the time that I've heard. If there's any clarification or property questions, there's some interesting ones. You can get pretty creative with leveraging if you have multiple investment properties, doing cash out refinances, pull them out, consolidate, paying off one or two properties completely, owning them free and clear. Of course, then you can put them in LLCs and do different things with them. And there's a lot of strategies to go through. So I just kind of open it up at this point, say, is there anything, I mean, it's, what is it? 7:15, everybody's probably inundated and half asleep at this point. So I just open it up if anybody's got questions on something that I might be able to answer.
Hey, Brent, I do have a question. When you're talking about reserves for multifamily, does that also apply for owner occupant as well? So it's like if I live in a fourplex, I need to have reserves for 3 of those 4 units?
I don't think so. Well, it's owner occupied. So technically, by definition, if it's owner occupied, they say you don't have to have reserves for that property.
Okay. Okay.
So that's where I would go with that. That's a great question, though. You caught me on that one.
Yeah, because it directly applies. So that's why I was wondering. So.
Yeah, that would be, I mean, you could shoot me an email and I could find out the actual answer to that specifically if you wanted to.
Okay.
But yeah, that's a great question.
Perfect.
And to piggyback on that, if I were to close a loan, are they going to look back at all the other rentals that I have for reserves? And then what about properties that are under private notes and things like that?
Well, if they're under private notes, they should pop up if they're recorded. They should show up when they do the lien search for your application. We do run into some that have private notes that are not recorded, which I'm like, okay, depends on how honest you want to be. There's nothing on paper to track that note around unless you're, putting it on tax returns and things like that. But if it's just your parents loaned you $400,000 and you're just paying them back, they wouldn't do that. But yes, technically you're supposed to have reserves on all rental properties, not your primary, but any rental properties. You're supposed to have those reserves 6 months PITI for all of them that goes into from whatever, like you said, 401k or whatever reserve account you might have.
Got it. One of the things that gets thrown around a lot in our circle, in investment circles, are closing in entities, LLCs, trusts, and things like that. Can you speak a little bit about how that can impact your ability to either close on a property or refinance a property and the timelines associated with those transactions?
Oh, you mean, so if they're more complex, how much longer it takes to kind of get all the paperwork flushed through?
No, more specifically, issues with, let's just, I'll pare it down to just refinancing. So if I have a property and I bought it under my own name and then I quit claimed it to an LLC and I want to refi it, say 3 months later, and then the lending institution says, well, it hasn't been owned in an entity for at least 6 months. And so then that kind of touches on the kind of a next question I have, which would be to discuss the nuances with seasoning, because that's another issue that I've run into a bunch when it comes to lending and refinancing.
Yeah, no, that's a great one. Most of the seasoning requirements for, we've got all different kinds of seasoning requirements, whether it be assets or investments. Most of the ones I see are 6 months is typically your window. But if they've got tax implications for how long you've held them, like the LLCs, maybe 2 years, you run into that investment property for 2 years, capital gains taxing, that sort of thing. I'm not a tax expert, so I'm not really sure on that, impact. But from the lending side of things, I haven't run into that where the only ones I can recall are where they say, hey, just pull it out of the LLC and you put it in your name. You owned it. It was in your name. You owned the LLC. It's still your property. You just quit claim it back, put it in your name, do whatever transaction you want to. And then you should be okay. That's always been my experience so far. If I recall, I'm trying to remember a specific example of that. But I know I've done that, but it was, several years ago, and the rules seem to change every 45 minutes on us. So it's kind of hard to track what's going on. But I know a lot of you, investors, it's a game. You're playing, you're kind of dancing around the rules and the math and everything, trying to make things fit. And it's kind of a unique thing. And then again, that might be something where a portfolio loan may come in where they won't do it with a conventional, where they're okay with it from the lending institution, but maybe Freddie and Fannie wouldn't be.
Mhm.
So those are ones I usually call our senior underwriting manager. And I just rack them in and just say, all right, here's the situation. Is this going to fly with you or not? And, at least try to get an answer. But I know I've seen some pretty complex investor files, and I'm like, okay, you got pretty creative yourselves out there with, how you move things around, and you have to be. I mean, that's how you make it in the game. Plain vanilla is kind of hard to beat it, especially when you got a lot of competition out there. You got to leverage.
Yeah, one of the pretty common strategies that a lot of these investors use is to buy a property that may not be financeable, or it just needs some work. And so they either buy it in cash or they buy it in a conventional loan and then go do a bunch of rehab to it and then put a renter in it. And then they want to refinance it at the new value based on the forced appreciation and equity from the renovations and the new market rents. And that generally can happen within a 2 to 3 month window of time. But the issue that I've personally run into is with the seasoning piece. And so I'm just saying this just kind of add clarity and bring it back to
Right.
kind of the standard process that we
that's
use.
a 6-month window there. That's and that's going to be your standard. Every once in a while, you can do some creative things. If you were doing a rehab loan and you have documented all of the repairs and everything you've done and everything, and get it reassessed. But by the time you do all that stuff, it's probably going to take 6 months anyway. So it's you just kind of put it on there. I just tell everybody 6 months from the time you got it, and then you can do a cash out refinance, recoup your investment money, and that's where a lot of people get that HELOC as a kind of an operating line. Especially if you can get a good chunk. If you've got a lot of value in your home, you get a $400,000 or $500,000 HELOC, and you just go pay cash for them, and basically you're financing your own flipping, if you will, and then you get it up to financeable specs and refinance it, because I've seen the math on those. You get a pretty good return on your investment, by getting something that's not financeable.
There is delayed financing as well,
and we do have delayed financing on some things, which that'll be a little bit more creative, but it's kind of that deferment. If things are getting done very, very quickly, like within a month or two, sometimes you can get delayed financing on a purchase, which is there's some institutions I saw they were basically pre-lending the cash up front and then doing things after the fact, but I have not seen a whole lot of success with those. The people I've talked to that tried to do it kind of crashed and burned on those. So I think those will probably fade out pretty quick. It was a good idea at the time for making people competitive in a cash buying market, but there's been a lot of problems with those things.
So just to kind of ask on that, the delayed financing is when somebody pays cash and then does their financing within a month or two. And so are investment properties eligible for that, or is it only primary residences?
There were some that were eligible. Yeah. That was in the game. Again, I've heard of some working and I've heard of some not working. But we were playing with a few of those. There were owner occupied ones that we were working with, but the same concept. And I think investment properties are still the same for those, right?
Yeah. One of the big things is that Ryan talking. I'm kind of off to the side. Okay. So Ryan, in your scenario, I don't know, since you were doing, it sounds like almost a rehab, if you were trying to take out additional cash above your original investment, you would have to wait the 6 months. And since obviously now the property's fixed up, so maybe that's, I don't know if that was the scenario exactly, but if you're just doing a delayed financing where you're refinancing the existing investment you put in, you can do that within, I can't remember the exact time frame. It's like 1 to 2 months, or it might even go up to, I think it's like 1 to 2 months. But you can do that for your original investment.
But if you're trying to recoup some of the renovation costs that you put into it as well, then you're going to have to wait.
Exactly.
Thank you for clarifying that.
Brent, Matt Fitchett here. First of all, thanks for taking the time to speak with us tonight. It's great to learn from you. How do you determine as a lender or a bank whether you do a conventional or a portfolio loan? And if so, if it's a portfolio, can title be in an LLC, even if it's 1 through 4 unit property? And then is there different underwriting for portfolio loans, more or less overlays?
Okay. The LLC thing, it's going to be the same. They're going to say you can't be in the LLC if it's a portfolio loan. You might find some hybrid credit union lenders that may or may not allow that in their personal or their institutional portfolio. I know we don't, and the banks in general won't do that. They're going to stay, still has to be held as an individual. As far as which product to recommend, I usually look at the situation and say, all right, what possible combinations could we use? And then it's just a math problem, which is right now I know we've got a great deal on portfolio stuff for investment properties, do them on 10-year ARMs, but the interest rate is basically a full % lower than in interest rate, and it's fixed for a decade. So we've been jumping all over that one. That's been a very, very popular product right now for us because the other agency adjusters have made the interest rates relatively high in comparison. And I'll take a % + interest rate differential on a loan that's fixed for 10 years all day long. That's going to pencil out for me. But as far as every individual, so we look at the combination of how much down do you have, what's the rate, and I usually put together a full spectrum of, here's all the options, and then here's the pluses and minuses to each one, which one would fit your scenario better or your needs best. Sometimes you have to go portfolio. Obviously, if they're in jumbo classification, those are all going to be in the portfolio world. But we look at those and the units, what kind of properties are they, all those variables, we just try to kind of shake them out. But almost everybody, I can't even say there's a cookie cutter formula for it because almost everyone's unique. But then you had a third question. I don't know, what was that?
Your underwriting, is that changed quite a bit for portfolio loans, more or less overlays?
They're less on some things and more on others. I always tell people, whatever Freddie and Fannie are going to require, kind of expect the same sort of general parameters, but they tend to get a little bit more flexible with things that, income and assets that would be, not exact, or, hey, we're close to a time limit on something, a seasoning limit on assets or something like that. They may be a little bit more forgiving as far as, all right, we're close enough, we'll let that go for our institution, even though Freddie and Fannie would say, nope, there's a black and white line. So yes and no at the same time. And self-employment, there's a lot of that sort of thing too, that gets a little bit more liberal. Portfolio loans, again, it's the institution is able to make whatever judgment call they choose to make on it. So there's a lot better chance of arguing through a gray area on a portfolio scenario versus a Freddie or Fannie.
Okay. Will you go one more time through the an ARM but 10-year fixed portfolio loan that you guys have?
So one we use, it's the SOFR, which is they replaced the LIBOR because the London interbank overnight rate that the LIBOR used to be based off, they kind of eliminated, figured that wasn't real accurate. So the SOFR, which is kind of the new main overnight lending rates. So the 10-year ARM, for example, it's going to be a 30-year loan, amortized over 30 years, fixed for the first 10 years. And then the rate can adjust every 6 months. And there's a cap, which will typically be 5 points, 5% over whatever the initial rate was, is the lifetime max on the loan. And So it gets a little convoluted. If you go just to give you an example, if you go year 10, say the interest rates were 4% higher, great. They'll adjust you. You had a 3.5%. You're now going to be at 7.5% on year 10. Then 6 months later, they could adjust it again. And after that first adjustment, they can never adjust more than 1 point at any given time. So it gets a little bit fuzzy, but I mean, I can script it all out, but that's kind of the general lock on that thing. So I always tell people, if you're getting an ARM, have a plan to have that thing paid off in 10 years, or realign it, refinance it, do something. But we had a lot of those that happened, a couple of years ago, where it's that ARM matured and the rate actually went down, and they were riding 2% money for 5-6 years, and they were, loving that thing. And then it was, nobody wanted to refinance. They were just riding the wave, and obviously not what's probably going to happen from this point on, but you never know.
Thank you.
I have a question I can throw out for Brent. Can you talk a little bit about the use of gift funds for owner-occupied investment properties? Can you use gift funds for owner-occupied investment properties? Because we know you can't for investment properties.
So yeah, so if we go back to look at some of those multi-unit owner-occupied properties, the gift fund scenario does apply for that. So you can kind of play the game in there a little bit in those unique situations, or hey, you've got a duplex and you want to go in there, you could get gift funds will be applicable to use that if you're going to occupy it.
So with regard to gift funds, you can use gift funds as long as they've seasoned in your account for, is it 2 months prior to the purchase?
Gift funds don't have, if they're gift funds, they don't have to be, but
I'm sorry, on investment specifically.
Well, just don't tell us.
Right.
Yeah, I don't want to know about it.
Yeah,
That's what I'm asking.
It's 2 months.
It's
2 months
2
bank
months.
statements.
And they're not a gift. Okay.
Whatever happened, however the money got there 2 months ago, I don't care. It's there. It's yours.
Basically, yeah, we need 2 months bank statements. If there are any deposits, large deposits, we need to source them. Gift funds are not an eligible source for investment properties.
Right.
Just a quick follow-up there. Has that always been true? Is that a recent change? Like, I'm just curious. Is that been a long-standing rule?
That's been, yeah, as long as I can remember, that's been the rule. It's just the 2 month seasoning, and as long as it's been in there and you can produce two bank statements that show the money was in there beforehand, nobody's going to look back any further than that.
I've got a question here.
Go ahead.
Had a couple incidents of either two different couples looking at purchasing investment properties together, or even myself with a few friends talking about potentially purchasing a property together. Logistically, any recommendations for that, especially if we can't do it in an LLC? Any recommendations? Are we all going to have to get it approved? And you guys going to create an avalanche of paperwork for our loan officers? What should we know?
Yeah, I mean, I've seen that happen where some people will they'll do it and only a couple of people are on the loan, but you've got multiple extra folks on the deed, but all of the qualifying and all of the cash is going to have to be vetted from whoever's going to be on the loan itself. And so we run into that where you have one individual come in there saying, hey, I've got 200,000 to put into the game, but I don't want to be on the loan. And somebody else is like, hey, I've got the debt ratios, I can make the loan payment. We'll go in together and we'll be, we'll split out the equity this way and we'll each be owners on it. And that usually ends in catastrophe. So everybody's got to be on the loan that wants to participate. And then, of course, once you have the loan done, you could quit claim back and forth, do whatever you want to with it. But as far as the actual loan part of it goes, that can get tricky. Buying with other couples, it's very difficult when it's not. The LLC kind of protects everybody for that thing. So it's makes it really hard when you're getting a loan. Sometimes maybe those are one of those where a commercial loan does make sense. And then you can do it with, as a business loan, and then everybody's vetted out accordingly, and you're protected, or that, or you really trust the people you're working with. But, anybody that's done that with friends or partners or anything knows that, it can start out real well and can end very poorly. So you really want your protections lined up on that, so everybody walks the line. But it can be difficult on the financing part of it. So no good answer.
I got a question as it relates to condos in an HOA, and the struggles to get them financed. Should there be more than one owner that owns more than one unit, and people not paying their HOA fees in a timely manner?
HOA fees can be always fun, and part of the condo certification when we do those is we will go get the property management or the HOA management. We will get all their bylaws, we get everything, and we check them and make sure. And we have to prove, and they have to actually have they have to be bonded. They have to make sure that those HOA dues, they're all in there. They gotta prove a whole bunch of stuff to make sure that they're solvent and that they are getting those funds. Some condo associations have limits on, how many units you can own. A lot of them have, used to be the condos wouldn't get approved for financing if a certain percentage of them were non-owner occupied. In other words, it's a giant complex full of investment properties. Risk-based assessment on that was that, the propensity that something could go wrong and people not take care of it, and the paper might go bad on that. We're up. I think they've lightened up that quite a bit, but they do extensive HOA background as far as the condo certifications when it comes to the lending side of things. I don't know, but they do vest them. They make sure that they're insured, so the HOA manager can't run off with all the HOA fees and the rents and disappear. And they've got insurance policies from a lending standpoint that they make sure are in place. So I don't know if that answers the question, but it's kind of,
yeah, no, that does.
I got a quick question. I feel like we might be transitioning more, especially for first-time home buyers, to want to rent by the room. Like they purchased their first home and then they're renting by the room. I don't know how many of those guys are doing actual lease agreements with these roommates, or if they're doing like an Airbnb by the room. Does that rental income, if they're able to show that it's income, is that alone enough to decrease DTIs or use that toward, rental payments, like to increase their income? Or how would one go about that as far as like a first-time home buyer looking to, they got the first deal, looking to refinance and move on to the next one?
so as far as qualifying, what they're going to do is they typically revert back to the tax returns, and they're going to say, what did you claim for income on that? And they may want to see the lease agreements to show, in fact, that that's what you're getting. But that's always one where it's like, well, they just give me $500 a month. I'm like, well, that's fantastic, but did you claim it on your taxes? Because that's where the buck stops usually with underwriters is we get all kinds of interesting income that come in from people, and they tell you this, that, and the other, and it may be true. Oftentimes it is, but it's what gets reported. So I'd say, hey, you got at least 1 year tax returns, and you can show that you were claiming this much rental income from it, and you have a lease agreement in place. Then that gives us a pretty good argument to run with an underwriter saying that's legitimate funds. But if it's just, hey, we got in the back of a napkin here that they're going to give me this per room, you're like, well, that's great. If you put it on your taxes, you got a pretty good argument that you're claiming that income and you're showing it. If you're willing to pay taxes on it, they're assuming that you're not lying about what you're actually getting income on.
What about those that are doing like a short term, like they have like a ADU and they're doing an Airbnb with it? Is that more or less the same thing, or do they need to show that they have a lease agreement to some capacity?
I would say it's more because a lot of times if it's inadvertent, and that's what we used to do that with the Airbnbs, or the rule used to be, I think if you're using it, certain times, hey, you're using this as your vacation home 6 weeks out of the year, and you're renting it in between on different times, and it's showing on your taxes, and especially if you have a management company that's doing it for you, and they could go back. So any kind of documentation or paperwork to substantiate your story, whether it be the tax returns, lease agreements, management companies, that's what underwriting is going to look for. And they get fairly flexible on that stuff, provided, the rubber meets the road at some point, and they can actually tie everything together. That's really it. If it's actually happening and there's a way to prove it, then you got a solid argument. If it's all, well, no, trust me. Yeah, they don't trust anybody.
Sure. Gotcha.
So one idea I had with Airbnb is you might be able to create a management company.
It's like
yourself.
questions and answers now only. The presentation's done, but they're talking about Airbnb.
Hey, Ryan Wilson, we're hearing you a little bit.
Okay. So one thing that maybe you could do if you're looking to use Airbnb income is you could create a management company yourself to receive that Airbnb income that you can record on your tax returns. Then that way that business is getting the income and you're using that income as a business itself. And then we're not having to worry about any actual lease agreements or anything coming out of the property. And that company is actually receiving the income, and maybe they pay rent to your rental property or something like that. That's one way you might be able to get around using that. One thing I did want to note, so if you're an individual with a single family primary residence and you're looking to rent out your room, we can't use that income. Though, even if it's on your tax returns, your primary, if it's a single family residence, there's just no way we're able to use it. It's just not considered consistent enough. And yeah.
Unless, yeah, I mean, I was thinking more there's, if you had like a ADU kind of situation or something like that.
Yeah, that might be an exception. Yeah.
And it doesn't help that they keep changing the rules consistently on us, which, makes it kind of a little crazy out there.
Hey, Brent, I'm just curious who else is talking there. I was a little confused on who was talking, so I'm just who's talking.
Yeah, sorry, you guys don't see me because I'm trying to stay the 6 feet apart, whatever stuff. But
so voices in my head that just kind of come across. It's just weird.
I'm Brent's assistant. I kind of handle a lot of the tech stuff, and I also help with a lot of the buyers as they're going through the process. So I'm sitting here just assisting Brent.
He's my analysis paralysis guy.
Yeah.
But I have one of those.
My name's Nick, by the way.
My therapist and my handler. Anything else? Super saturated?
Looks like we got it all. I appreciate
Brent, I have one more question about the portfolio loans, if I can sneak that in.
Yeah.
Let's say I have 6 duplexes on 3 parcels. I'm assuming you guys are willing to look at 1 through 4 units standalone by themselves, or a true portfolio loan. How does Umpqua Bank feel like if I were to sell off 1 parcel or 2 duplexes? Would you want me to, would you guys carve off the valuation, or how does Umpqua deal with something like that?
So you've got 3 parcels and each one of them has a duplex on it?
Each one actually has 2 duplexes for 4 units. So there's 12 units, but it's on 3 parcels of land. Okay, so we would consider that 3 separate properties, 3 4-unit properties. So you would want, Umpqua would want to write 3 different portfolio loans as opposed to 1 portfolio loan that encompasses 3 properties? Correct. Okay. Yeah, the 4 units, the max that go. The interesting ones get when you have a 0 lot line, or you've got these crossovers, which can get really fun. And like, well, okay, you've got 4 units, but it's 2 tax lots. So is it 2 duplexes, or is it a 4 unit on 2 tax lots? And that can get kind of interesting debates as far as how we're going to call that. But again, that usually ends up being an appraiser definition.
And, you go down a rabbit hole trying to figure out, which appraiser you're going to get, and then it's a crapshoot.
Do you guys have commercial options then to wrap that into a single loan as a commercial versus residential then?
Yeah, we've got commercial lending, obviously at multiple tiers. We've got folks that do all the way up to the, 100-unit apartment complexes and everything there. So I just kind of take the low end stuff up to the 4-unit properties, and we try to get the residential lending. The commercial lending, of course, totally different terms. They've got all different kinds of balloons and different setups for those things. They get much deeper into your depreciations and your ROIs and your the real penciling math that comes with those types of things. Bueller? No. Okay, well, I guess, if anybody's got, my stuff will be on here. You could, if there's anything I can help with, please just, shoot me an email or anything. And we'll just kind of go through. I think, this will be on there. So I've got my, information, whatever I can help with, questions on stuff or what ifs or anything. And if I don't have the answer, I can certainly call up to the top of the house and get senior underwriting managers to even call in and check with Freddie and Fannie and ask on specific situations. Just anything I do to help you.
Perfect. Well, thanks for your time, Brent. That's a bunch of great useful information, and I'm glad everybody got a chance to ask questions too.
Yeah, always around.
Really appreciate it.
Yeah, always chained to my desk. So I appreciate the time with you guys and getting an opportunity to talk to you. It was good.
Thank you for staying late tonight. I appreciate it, both of you.
Thanks, Brent. Appreciate it.
All right. Thanks, you guys. You take care.
All right. You have a good night. Thank you.
You too. Bye.
Well, Jesse, you want to make any more announcements here? And we got a few things going, or what do you?
There hasn't been much on the property management front that I think needs to be shared at this point. But there's things in the works, and they're kind of just all stalled out at the moment, legislatively. So as soon as we get an update on those, I'll share them with the group. But I guess no news is good news on the management front. I know you got some stuff to share, Ryan. Let's dig in.
Yeah. And again, if you guys got to go, I was going to share a few things from a conference I went to just a few weeks ago on the real estate side of things too. And don't feel bad if you got to jump off here, but again, mark your calendars for the second Tuesday of the month, and tentatively 6:30, and start next month we'll be back in person. So really excited about that. I'll share a few things. Let me pull it up here, desktop 2. Let's see if that's gonna work. Share. All right, you guys seeing my screen there? Hopefully. I just before jumping into some of this other stuff, I saw this headline and read through the article. I don't know if you guys saw it, but just real quick note that there was a suit in Corvallis. It looks like somebody, a landlord who's been in some other interesting lawsuits. It looks like in the past. Had several rental properties on a well, and the well came up high for nitrates, and one of the residents there, they were pregnant and had a baby and had a lot of issues, NICU and a lot of other things. Now they're being sued. They brought a suit for over $700,000. So just a quick reminder to be great stewards in our community. We don't want this kind of thing. And of course, one of our biggest missions is, if you're, multifamily or, residential landlord, is to have a healthy place for your for your tenants. So just kind of bringing this to your attention, and test water, test for lead-based paint, or whatever you need to do, and make those disclosures the right way. So yeah, cool. Like I've been kind of teasing here, I did go to a conference in for Keller Williams. We had there's a couple 100,000 people almost now in our organization, and so our top economic person came through and gave a 3-hour presentation. I'm going to try and distill some of the things that I thought were interesting down to about 5-7 minutes here, but stop me if you guys have any questions at all. And again, it was some of my key takeaways, but stop me if you've got any questions. So some of the interesting things, just looking at total number of home sales. So we're if we look into what's projected for next year, maybe a little less than what happened in 2021. We're looking at close to 6 million home sales, which is about what we saw at the peak of prior to the Great Recession of 405. They were hitting about those same numbers. And so if we look at the 5 years of the hottest time then versus now, we're seeing similar numbers. And so just letting you know, there are a lot of transactions, a lot of things going on right now, a lot of homes turning over. So this chart is showing basically the average home price in the US, and annual median home price there. And what I guess what most people look at for annual appreciation is a 4% number. Excuse me, knocking stuff around. 4% number. So if you go back all the way to the 90s, that trend line held pretty good there until we had the run up to the Great Recession and that bubble. And you can really see the bubble on this chart, how this graph is laid out. We saw that we came down below the 4% appreciation line, and in 2021, with significant appreciation last year, we came above that. So nationally, 347,000 was the median home price last year. If we get to where our Keller Williams economists expect, we'd see about 378, which is above what we see as this trend line of 343, which, depending on how you look at things, kind of gets into that, makes some people a little queasy. Hey, are we in a bubble or not? Of course, there's a lot of differences between now and the 05, 06 we can get into too here. Let's see. Another way to look at home price is just looking at per year, the annual appreciation. And so this is an interesting chart, kind of break up some different, I guess, segments, and saying, yeah, in those 90s, it was kind of that flat, almost 4% every year. Then we had the run up, and one of the highest appreciation years is 05, when there was over 12%. And then we had the 5-6 years of declines, and we were in the Great Recession, and how we've clawed back in 2012 to 2019. And you look at last year, 17% nationwide home appreciation. We were very, very similar to that in the Willamette Valley, 16 to 20%, depending on what metro area you look at. So we're right in that same range. And so, that far exceeded anything we've seen in 30 years. So it was a crazy year. This point, and this was again 3 weeks ago, as they were projecting things, saying 9% was the projection for the US from our economists. So let's see. So inventory, agents love to talk about inventory. I don't know if, how much everybody understands that, but I'll take a quick step back and explain that. Inventory, what we look at when we talk about inventory as agents, is really how fast are things selling versus how much is available. So if we look back and say, okay, last month 100 homes sold, we look at how many houses we have on the market and say, kind of, hey, if nothing else came on the market right now, how many months of available homes do we have? And so again, if we had 100, for sale that sold last month, and now right now today we've got 300 on the market, then we've got inventory of 3 months. We would expect there to be enough homes for 3 months at the going sales rate. And so looking at this historical number here, we are way down. And what we see as a balanced market, we also like to throw out the term seller's market or buyer's market, depending on who has more control in the relationship, who has a bigger swing. And of course, we're in a huge seller's market right now because we have such low inventory. The seller really has the bargaining power. So nationally, we're seeing 2.3, which is, you can see it's kind of less than, it's probably about half of what the average has been. In the locally in the Willamette Valley, especially looking at the last 6 months, we've been hovering about 1 to 1.5%. Several months in Albany, especially, we're looking at half a month in inventory in the fall and going into the winter. So right now we probably have right around a month to a month and a half of inventory. A little bit of that seasonal, but it's been holding pretty steady. And so this is a little bit more granular look at that. So as the orange is 2020, we did, of course, right at the beginning of the pandemic, we were already kind of low inventory numbers historically. The pandemic happened and a lot of things sat for a couple months, and that's where we see the spike. And then things really came down, and you come across then and look at 2021 and the numbers across the year, and you see things got a little bit better in the summer, but really came down in the winter here. So again, stop me if you have questions on anything or want me to back up and show something else. Mortgage rates. So Brent talked a little bit about rates and where he thinks they're going. This is looking at those prime 30-year owner occupied. And so last year we had right about 3% was average. And now we're back up to right about 4 right now. We're way under the historical average. Going back to the 70s, 50-year look, we're way below because that includes the 80s, late 70s and 80s when we had really high rates. But even if we look back, take that out of the equation, look back at the last 30 years or so, 6% has been average. So we're still, fair clip below average right now at 4% is historically very low. Even at 4.5 or 5%, it's not fun, but it's better than average. This is another thing that I thought was really interesting, looking at affordability. So, and affordability is looking at the median household income in the U.S. versus the median household payment for the homes being sold that year. And that's just payment and interest. And this is a percentage. So if you look across here, again, when we had higher interest rates, you get into the 30% range. 30% of your income would have gone to your payment and interest. Again, doesn't include taxes and insurance, so not the full PITI. But you look at right now in the last 10, 12 years with these rates so low, it's been in the mid-teens here as far as affordability. The interesting number that they threw out was looking at first-time home buyers, and actually, unfortunately, first-time home buyers, this is skewed quite a bit different because, of course, their income is traditionally less. They've got, they're riddled with student debt and a lot of other things, and so this number doesn't look near as good for first-time home buyers. I didn't screenshot that one, but just kind of a note that this has gotten worse, not kind of stayed even, but gotten worse for first-time home buyers when you look at affordability. Just a couple more quick slides here. I don't know if I'm going over my time, but I'll keep it short. Looking at what's ahead, look at gross domestic product, unemployment, wages, income by sector. I didn't screenshot that one, and inflation. Looking at GDP, GDP is, they kind of target 2% or so. 2% is, usually feels kind of normal to us. If you look across that, that's going to feel like a fairly normal economy. 3-4% feels like things are really going. 4% would feel really, really strong economy. And so, numbers are skewed up and down last year with COVID, but this is where we've been seeing things. Unemployment, if you look across to 2021 and where we ended up, we're still above, and came out with some new unemployment numbers, and they're looking better and better. But really, that encompasses about 2 million people that would be in the right age range, but have not re-entered the market for employment. And so we're still kind of waiting to see those people trickle back in. And it seems like, as I've been watching unemployment reports here the last couple months, they have been trickling in. So hopefully getting back to better and better employment, and seeing that those numbers keeping improving here, not only for people having jobs, but for employers that are so understaffed right now. Real wages. This was kind of interesting to see. If you look at the hourly wage adjusted for inflation, how does that look? And generally, the last 10 years or so stayed a bit positive, right around 1%, improving. And so that's going to improve what people feel like they can purchase and everything else. Last 2020 was great. And then with the start of inflation, the second half of last year, that's gone down. And so people started feeling the pinch a bit last year. And, kind of looking at inflation, which I know is on everybody's mind, and, talking and looking at that. I guess the things that I took away that are different than other people are talking about is that really the goal is to keep it close to 2%, which matches up real close to the GDP. So if GDP is going up 2% and your inflation's going up 2%, things feel pretty even, right? That you're, that things are going up and everything feels even overall. But as we're hitting these crazy inflation numbers, it's pretty uncomfortable for everyone. And, I guess the big, when I went to this conference 3 weeks ago, of course, the invasion to Ukraine hadn't happened. That was a big question mark. Hey, what's going to happen there? And so, they said, barring that, we think inflation is going to get better because people have been transitioning during the pandemic from buying stuff, which is, created all the backlogs and all the needs for items, and has, made things worse as things are not available, but transitioning now as we're coming out of the pandemic to services. And so that should help a lot as people's extra income, their spending power is going from goods to services. The inflation numbers should be looking better. Now, of course, everybody's talking about gas prices and everything else, but as those things happen, I personally a little less hope, as I did a few weeks ago, for things improving on the inflation side quite as quickly as our economists were looking at. I think this is the last slide I have here, and just a few numbers on hey, how things changed in the last I guess this is 32 years, as far as how has inflation changed things over the last 30 years and affordability for different things. And it was kind of cherry picked a little bit. 1989, I feel like, I don't know if there was significance there, but if you look back, cars were selling for $15,000 in 1989. If you adjust that for inflation, that's $35,000, whereas the average car right now is $46,000. They were saying a lot of that's based on computer chips and extra technology and safety that's being put into cars. The gas numbers are now way off. Even 3 weeks ago, we were seeing actually more like a real change of 100%, if I'm doing my math correctly, because I paid $4.50 yesterday, whereas it was $2.25 adjusted for inflation 30 years ago. So that's obviously the big number. I guess what they wanted us to take away as agents here was looking at affordability. And this is why I think they kind of cherry picked some numbers out of here. But if you look at, in 1989, the average mortgage was $825 a month. Wouldn't that be nice? And now that adjusted for inflation would have been $1,900. But right now we're actually seeing, because interest rates are so significantly lower, 1,400. And so really, purchasing power, affordability looks a lot better than it was 30 years ago. So that was some of my key takeaways. Any questions, anything else that people saw or thought about on any of this thing, or thinking about with the economy, things that they're hearing from talking heads that they think are for the good of the order? One of our title companies shared a video yesterday about commercial real estate, and they were talking about Ukraine and saying that they didn't think that a lot of things were going to have a big impact on commercial real estate in general, partly because of longer time frames, for longer leases and some other things. But anybody here, any interesting news or talking heads about what they think is going to happen here as we're in such a weird time?
Gas is going to go up or something.
I've heard that. I don't know.
I'm just kidding.
Every day, 40, 45, 50 cents. It's crazy.
So what's that? I guess I see two direct results of that. Number one, those people that do commute and our tenants that commute, is they're going to have a lot more problems keeping to their budgets. 60% of Americans live paycheck to paycheck, and so this is gonna, this could directly result in people's purchasing power, what kind of apartments they're looking at. They might, instead of going for the highest end ones, kind of start looking at cheaper options. Doesn't mean that people are going to all of a sudden, it could create more people trying to move around to be closer to their jobs now too, if they are still commuting. I think it's also going to keep pressure for those that do get the opportunity to work from home to stay working from home. Everybody that's not working from home is saying, I don't want to go back to work. I don't want to go back to work. And I think this is going to be one more piece where they get to tell their employers, hey, I can't because of costs. So I think we'll see that extended, but I don't know. We could see some more people trying to move around because they need to be closer to their job, or it pencils out to be closer to their job.
Yeah, I'd be curious. I'm curious. Like, it could be pretty short term, depending on how things go over there, and how we adjust to those things. But that seems reasonable to me in terms of the short term impacts that you're just talking about.
I think that the gas prices alone will increase inflation as well. And that's because everything that we purchase is on a boat, on a train, on a ship, on a truck. So, people will consider the gas prices when they think about filling up their monthly budget from a standpoint of filling up their car. But I think every single thing that we purchase on the daily will go up as a result of the gas prices. And I think a lot of consumers don't think about that aspect of it.
I agree 100%. Everything. There's so many petro products, right? So flooring, LVP flooring, like little things like that are just going to go woo.
Well, fertilizer. So food products.
Fertilizer.
Part of fertilizer. I was talking to my dad. He's got property in Kansas, and my uncles all farm out there. And a year ago, fertilizer was $400 for whatever unit it is. Now it's more than 3 times that, almost 4 times that, $1,500 per whatever gallon bushel. I don't know what it is. So,
well, unassociated with the Ukraine thing, I mean, lumber's been in as still again after a high last year, a large dip, and then we're back at it again. So lots of different fun things going on.
I don't know if that's gonna, more quickly lead to less consumption on goods, or if that's gonna limit, that going back to what we were hoping of, more people putting their money towards services and thinking about eating out again or going on those vacations. Anyway, I don't know. it'll be interesting to see. Well, yeah, I don't know if we got too much else for you guys tonight, but I love talking real estate in whatever ways that you guys want. I'll stick around for a few more minutes here for sure. If anybody has any other questions, want to talk about a deal they're looking at, or if you guys have any deals that are available, or that, you know, somebody's looking for something that maybe somebody else in the group can help out with, you know, this would be a great opportunity to talk about that.
Hey, Ryan, we're always looking for a 2 to 4 unit in case you have one floating around.
2 to 4 unit, Corvallis or across the valley. I saw.
If it's cash flowing, I don't really care.
I'll throw this one out here in terms of just doing things differently and trying to find good deals. I spent 20 minutes on Google Maps just looking for large roofs near campus, just searching, found a big roof that I wasn't familiar with, dropped a pin, dropped to street level, found the address, found the owner, wrote him a letter. Hey, you want to sell this? Hey, funny, we were just talking about selling it. And now under contract for 2 fourplexes that were, you know, they were just kicking around the idea. So don't be scared to get off the rails and do something different. And there's not a lot out there, but you can find some things, and it just takes a little bit of time.
So was it just the one letter? Have you been sending 10 or 20 and got one great response? It was
worth it. Yeah, it was the
really,
one letter.
Wow.
And I wrote him a letter, and I have this database where I can just find phone numbers, call them, said, hey, and he was like, my wife and I were just thinking about selling this. It's funny you call us today. So yeah, there's ways. And it didn't help, or it didn't hurt that it was part of a trust. So that they're on a timeline as well. Either they're going to hold it forever and it's going to be their kids, or they're like, hey, you know what, let's cash out while everything's high and move on. So
yeah, don't be afraid to ask the question. I mean, so many people are changing priorities. I mean, people are seeing that it's a good time to sell. So other investors, I mean, I'm talking to people that are saying, hey, we're getting ready to retire. We want to go from, you know, building to taking this as an income stream or whatever else. So yeah, there's always opportunities there. Cool. That's a neat story. Look at big roofs, huh? I've been looking for small roofs on big lots. That's been my strategy, thinking about all the change in legislation here with House Bill or State House Bill 2001. Yeah, and how that's going to change things. So,
well,
yeah.
I've been doing some homework on that front. It sounds pretty interesting. I would love to hear some more educated information about that.
I mean, the basis of it is that any single family lot in a town that's over 25,000, you can build 1 through 4 units outright. You do have to meet their design standards, but the city, I believe it's stated, they cannot make it prohibitively more difficult to develop than what the existing code would make it. And then 10,000 to 25,000 population municipalities outright a duplex on one of those lots. And their code can allow for 4 units, but you can outright build a duplex on a single family lot.
So you're saying that essentially that whatever setbacks and whatever, you know, size regulations they have in place now, it can't be more restricted than that?
That is correct. Yep.
Yeah.
But, you know, obviously, if you try and put 4 units on a single family lot, meeting the setbacks and meeting the, you know, like the density requirement of, like, you can cover 60% of the square footage of the lot. And then there's also impervious surface requirements for percentages. And one of the things they could not do is they could not up the parking requirement past like what it was currently at. And some municipalities are basically doing away with parking. I know Bend, you can put 4 units on a lot and only need 1 off-street parking space. And so you can do a triplex in Bend and have no off-street parking whatsoever now, which I think maybe is a little bit problematic, but we do need to push for density.
I feel like in the last 10 years in Corvallis, it almost went the opposite way of that, which is not surprising necessarily for Corvallis, but there were some places built that had 0 parking, and then there was a bunch of pushback from the community. So that's interesting.
Yes.
Corvallis, yeah, they're gonna